Welcome to the Mutual Fund Show. I'm Neeraj Shah. For the next 20 minutes, we'll talk about two key aspects on mutual funds. Now, I'll start off with the ELSS scheme simply because viewers I generally believe or genuinely believe, and I think Kaustubh Belapurkar will stand testimony to that whenever we've done a show around ELSS funds in the months of February, trying to tell you which are the best funds to invest in, an advice that comes up concurrently is that don't wait for February. Start from April so that your investments get spread out. It's not as much load towards the end of the year, and you can take true advantage of systematic investing, as we call it. And I think that's why we thought that towards the end of April, it's a good time to try and talk about the ELSS schemes. Some of you might think, abhi to bahut time hai. I think this is the best time to do that if you want to indeed invest, and that's why we're trying to do this show today. Gentlemen, both of you, Rushabh, Desai, Kaustubh Belapurkar, thank you so much for taking the time out and being with us. Kaustubh, the ELSS part, I'll start with you because we've had a bit of a history around ELSS schemes, right? Give us your thoughts. Is this a good time as any to start?
Yeah, hi Neeraj, and thanks for having me on the show. So I think we've spoken about this for the last few years, and glad to be back discussing ELSS. Obviously, perhaps the paradigm is slightly shifted given that the new tax regime versus the old tax regime. ELSS may not make sense in the traditional sense for all, but I still think that they're fantastic, investment opportunities. Tax benefits aside, just as standalone investing opportunities, they're great. And like we've been talking about, they're like any traditional diversified equity fund, right? So when you look at an ELSS fund, the only difference technically is a 3-year lock-in that comes in, and I think from our perspective, that's actually a great thing because it kind of just instills some discipline in the investor who's not looking to redeem that in a hurry. So that's a great benefit. It also adds an additional benefit to the fund manager where he or she has visibility about the assets that remain for a certain amount of time, so they can manage it more efficiently. And like you rightly said, that we're having this conversation at the start of the financial year, which is great because investors tend to wait. So even when you look at flows in ELSS funds, they tend to be lumpy towards the end of the financial year. And our advice to investors has always been, like you're doing your SIPs and in other diversified equity funds, why not do that in an ELSS fund also? You're getting your tax benefit, especially if you're in the old tax regime. Plus, you get the benefit of kind of systematically investing rather than, putting that money right at the end of, when the market could be up or down. You'll be really subject to the vagaries of the market movement then.
Well, actually, our HR manager tells me that a bunch of guys are still in the regime wherein all of these things will be applicable. And therefore, I thought that might be true for a bunch of others. And that's why it was important to do this, Kaustubh. But your point is well taken. Rushabh, does your view differ when it comes to the ELSS investing?
Neeraj, thanks for having me on the show. I completely agree with Kaustubh that, starting early makes sense. And, we have observed that, because see, markets are very unpredictable. You don't know how the markets are going to be at the starting, mid, or the end of the year. So when investors rush in probably during the month of Jan, Feb, and March, end of the financial year, they really don't know how the markets are going to be. See, today the markets are reasonably priced. That's different. But what if someone would have invested in 2021 or so when markets were expensive, right? So they wouldn't have got that kind of returns what one would expect in an equity as an asset class. So I usually tell my clients, do in a staggered way, divide your money, do a SIP month on month. I think that is the best way to do it in an ELSS. If you're taking other products like other categories, then if you're doing lump sum, that's different because you can still time the markets in that sense when the markets fall. And we have seen historically markets have fallen anywhere between 10 to 20% year on year. But when it comes to ELSS, especially tax saving, I feel that it should be done in a disciplined way, and a staggered approach over a period of 12 months should be as an investment perspective should be spread out over the period of 12 months.
Okay, so viewers, and I presume all of you agree with the kind of views that both our guests have given, and therefore, Rushabh, may I ask you that if people are in agreement with that, and therefore it's a short argument, really, it's actually not an argument at all. What are the, if there are schemes that you have traditionally liked within this ELSS bucket, they may not necessarily be exhaustive list. They may not necessarily be the only ones. But if there are one or two examples you can give of funds that you believe are good on the ELSS side and people can consider looking at them.
I like actually two funds over here. One is DSP Tax Saver Fund, which has done consistently well, which has consistently outperformed the benchmark. And the second fund is I like is the Mirai Asset Tax Saver Fund. But again, I tell everyone that, don't just choose products randomly, match it with your existing portfolio. Say, for example, if your portfolio is more inclined towards growth, or probably choose a value oriented or a blended oriented kind of a ELSS product. And if your portfolio is more inclined towards value, then choose a growth oriented kind of a fund. So match it with your portfolio overall style. And we have seen, today value is doing phenomenally well, right? A few years ago growth was doing well. So value and growth both will have its cycles of outperformance and underperformance. So I feel having a balanced style in one's portfolio is very important, Neeraj.
Okay. Kaustubh, same question to you. Things that you're watching out for, schemes that you're watching out for.
Sure. And I think, Rushabh raised a very important point. When you think about positioning of a fund in your portfolio, it needs to be looked at from the context of the entire portfolio. And, we have very, very strong views on that. You need to blend styles within that and, not just pick a fund, as a standalone basis. It needs to look at it from an overall portfolio perspective. So I think one of the funds that Rushabh mentioned is also one of the ones that we like, Mirai Asset Tax Saver. I think, brilliantly managed fund, more, kind of a growth at a reasonable price manager. Nilesh, obviously a very, very seasoned manager who's been managing it. And, that's one fund that we like. The second fund, and, Rushabh also touched upon that, value has been obviously more recently been doing fantastically well. And this might, so if you look at this fund, which is the Axis Long-Term Equity, and, this is a more growth-oriented fund, right? So Jinesh, who manages this strategy, when you think about it, it had a stellar run in the years of 18, 19, 20 when growth was in favor. But if I just dial back time before that, 16, 17 were poor periods for growth. And it was a similar period as what we've seen over the last couple of years where value cyclicals were outperforming growth. And the fund did underperform. But I think the proof of the pudding in both these time periods, in 16, 17 and the last couple of years, the fund managers largely stuck to their growth style. So which is the proof of the pudding that, look, I have a process, I'm going to follow that irrespective of the market conditions that are against my style. So if you have a value bent in your portfolio, want to add a growth style manager, I think the Axis Long-Term Equity would, again, make a pretty reasonable choice within the ELSS bucket.
Okay.
Neeraj, I just want to add one more thing over here.
Yeah.
Is that, there is a 3-year lock-in period, no doubt about it, in the ELSS category. But I feel, people misunderstand that, okay, just because it's a three-year close-ended kind of a product, I will get fantastic returns over a period of 3 years. Equity as an asset class has been very volatile. We all know that. So in my view, I think a minimum 5-year period has to be given, depending on what point of time you're entering in the market. And if you're doing a SIP, I think probably 7 to 10-year time horizon would be really great.
Okay. Well, now, viewers, you can take your time horizons as per what you believe in, and please do not take whatever our guest or any guest on any of these shows are telling just at face value. Please do try and talk to your own financial advisor, because she or he would know what is best suited for your portfolio. Here we are trying to give a generalized advice based on a general portfolio, but do try and match it. Of course, if you do not have a financial advisor, then we try and get the best people to give you the advice. So you will obviously get some benefit out of it. But if you do have a financial advisor, please do consult. Now, for the second part of the show today, I urge you to please definitely consult your financial advisor, because thematic investing is not easy. It's not for everybody. And topic that we're choosing today is not, of course, just thematic investing, but a theme within that, which is pharmaceuticals. All through the trade setups and the talking point shows in the last couple of months, we've heard a bunch of people tell us about how pharmaceutical as a basket or healthcare as a basket is coming up on the screen. Every second day or the third day, you see a stock hitting new 52-week highs. There's a bunch of buying happening. So we thought it best to try and figure out that how do people who do not invest in stocks but want to take advantage of this play this via the mutual fund route, if at all. Rushabh, this piece I'll start with you. Healthcare funds, are they a yes or are they a no?
Neeraj, first of all, I'm really very bullish on the healthcare industry overall. I would like to break the healthcare industry in 6 parts actually in India. That's how the structure is. One is the pharmaceutical segment, hospitals, diagnostics, medical equipment, medical insurance, and telemedicine. Now, see, we are the largest exporter of generic medicines globally. right? And we are ranking in the top 10 or probably top 15 in terms of other drugs and medicines what are exported globally. So in that way, our infrastructure in terms of manufacturing, I mean, of course, we are still way behind than other developed countries, but our manufacturing infrastructure has been phenomenally done well in my view. So overall, as a pharma sector, yes, definitely is a big yes. Now coming to the healthcare thing, which includes hospitals, diagnosis, medical equipments, insurance, and telemedicine. I mean, see, in terms of hospitals also, like we have really quality medical infrastructure over here. That is why we are seeing a lot of medical tourism coming from outside the country as well. But at the same time, there are so many places where, quality healthcare or quality hospitals are still not available. Now, I myself being a differently able Neeraj person, I understand this segment very well because I faced a lot of difficulties getting quality healthcare over here, quality insurance over here. See, my disorder still does not is covered under the insurance segment, right? So we still have a long way to go in terms of say like having really affordable healthcare for the general public at the large. Now I'll give you one more data point for you and your viewers to ponder on. See, India's healthcare expenditure is actually less than $100 per capita, and if you see the world average, it is around more than $1,000. So you see the demand is very high. There is a lot of demand, but unfortunately, because of the low per capita, people are not able to afford healthcare in a much more better way. So
Sure.
although I see huge opportunity where there is negativity, so in my view, like the pharma segment, which is doing phenomenally well, plus the healthcare, which is as per the economic survey done in 2021, is expected to grow 3x in this decade. So combination of the existing pharma, which is doing phenomenally well, and the scope and the opportunity we have in the other healthcare segments, which is hospitals and so on, I really feel tremendous money can be made in the next 10 to 15 years in the healthcare thematic funds.
Okay. And Rushabh, I'll stick with you because Kaustubh's view is slightly different. So I'll first finish one side of the view and then move on to the other side as well, so to say. There is some data that you've given. You've spoken about some funds. You've spoken about how if we compare the 5-year rolling returns and the Nifty 500 TRI versus the Nifty Healthcare TRI, there is some findings out of that. Can you talk about this?
Sure. So if I pulled out data from 1st April 2010 to 31st of March 2023, that's a 13-year data of a 5-year rolling basis, right? So over this period of time, 45% of the data points showed that Nifty Healthcare TRI has generated more than 15% CAGR, right? And out of that 45% of that time period, 20% of the time period has generated more than 20% CAGR. Now, if you see the Nifty 500, right, only 30% has been able to generate, greater than 15%. And only 3% of this period has been able to generate greater than 20%, right? So there is tremendous, I mean, over a period of time, I pulled out the earnings data also. So, historically, the Nifty healthcare index has generated higher earnings than the Sensex companies as well. So the companies are doing phenomenally well. Returns wise also, we have been seeing that it is generating higher returns than Nifty 500. But one point I want to draw is that this segment is going to be extremely volatile and extremely cyclical. I mean, just before 2020, we saw a slump in the pharma and the healthcare segment. It's only after 2020 we saw a huge demand, demand for products. So much we've become very health conscious. There's so much of awareness for healthcare in our country. So it's going to be very cyclical and volatile. So in my view, timing has to be very important. The entry and the exit has to be very important in this sector.
And therefore, viewers, I think while Rushabh may not say it and he studies this very closely, so he may find it convenient to time it. If you believe for whatever reason, maybe your job doesn't allow you, maybe you don't have the expertise to be able to time this, then maybe thematic funds in general might not be for you. And maybe there is some other reason as well, as Kaustubh puts it in his findings. Kaustubh, I reckon from what little I've seen of your responses, that you're not necessarily in favor of a healthcare thematic fund or a thematic fund in general. Am I wrong or am I correct?
Yes, Neeraj, I think that's the general thesis, and I'll outline some of the reasons to why.
Please.
So I think Rushabh's very, very nicely articulated that there is a lot of merit in looking at, healthcare stocks, and obviously the opportunity pie is huge, right? I mean, we're a growing economy. Healthcare needs are increasing, and all of that is great. But I think from an investor's perspective, right, and I think Rushabh did also touch upon it, that timing becomes very, very crucial because, and we've just done a very simple analysis of looking at sectoral rotation that happens in markets, right? So you have different sectors coming to the fore at different points of time. So for instance, 2016 to 19 was actually an exceptionally bad time for healthcare stocks. And then 2020, you had this huge run up in healthcare, probably being the best performing sector along with IT, right? But the last 2 years have again been challenging, at least from a price perspective on the stocks, the calendar years of 21 and 22. So the challenge is from an investor's perspective, and like you asked that if the investor does not have the wherewithal to understand, the semantics of the sector, right, which I think Rushabh very, very keenly articulated, or doesn't understand when to get in, then that's a huge challenge because often then they're chasing the tail, right? And we've seen this in data, which maybe not so much for healthcare, but we saw this especially in the technology side, but probably played out in healthcare too. But a lot of money came into healthcare funds and technology funds after the run up in the, in the segment had already happened, right? So because the sector posted great returns, investors, who got into it just purely looking at the past performance. Now that's the challenge because they've come in with misplaced expectations. And they've obviously been disappointed over the last couple of years. And that is the biggest challenge that we need to address, that if you as an investor cannot take that call, either you go and work with a financial advisor who can guide you, and B, even if you do want to take exposure, keep it limited as a part of your portfolio. Do not go, because we've seen portfolios that people end up buying 20-30% in a sectoral exposure, which is massively dangerous because you're so lopsided in your returns as an investor. I mean, it can be boom or bust, and that's the challenge. Kind of want to outline because we've seen that happen with a lot of investors purely looking at past performance and coming in off a sector and buying into funds, and that's something which investors should definitely keep away from. The other thing, obviously, even your diversified equity managers will take graded, albeit graded, they will take graded overweight, underweight calls within their own diversified equity funds. So it's not going to be a 1 or 0, obviously, but they are positive on a certain sector, be it healthcare or otherwise, they would kind of look at it, right? Just the last bit on timing, and maybe the interesting bit is, given that we've had 2 difficult years of healthcare, and I'm just putting it out there, it might not necessarily be such a bad time to think about it. I mean, in conjunction with what Rushabh already outlined, but you need to be patient. You need to be patient because there could be a couple more years of, before the price movement on the stock happens, right? So I think that's something that investors need to keep in mind. But I would definitely not be recommending, someone to get into healthcare, say in the end of 2020 when the market had already moved up significantly. That would be the time to probably book some profits. So I mean, that's just my 2 bits on, sectoral funds as a general rule.
And viewers, I think the graphic point kind of lays out for somebody who is not adept at timing. And just look at, I mean, don't look too far and don't look at the entire this thing. But if you just look at the best performing sector in each of the last few years, you will see the turns that these guys take, right? And a lot of sectors who are the best which are the best performing sectors, are not necessarily the second best or the third best in the next year. They might be 8th or 9th best performing fund as well. So if you don't time it well, you might actually get it merrily wrong. Now, just before I move to Rushabh for some of the funds as well, I think there's an interesting point that you are making, Kaustubh, which I want you to explain, which is you are recommending that people should capture ratios of healthcare funds. Now, can you tell us a bit about this?
Yeah, sure. So essentially, the way we look at capture ratios, right? So this is obviously pegged of the healthcare fund versus the healthcare index. And essentially, what we're trying to do is, there are 2 capture ratios, both on the upside and the downside. It looks at the months in which the index, which is the healthcare index in this case, when it's positive, how much of that positive upside on an average does the fund capture, right? So in that sense, the higher the better, right? So I mean, if you're capturing greater than or close to 100 or greater than 100, basically you're getting a lot of the positive upside when the index is in the positive. At the same time, on the downside, because we've already outlined that it can be a very volatile index, you want to have a down capture ratio. The markets in which the index is negative, the fund should capture as little of that as possible. So the lower, the better in terms of a down capture ratio. So when you look at these two in conjunction, then you can kind of look at the funds that have done an excellent job over various timeframes in capturing the upside, at the same time limiting the downside, when the markets have generally been negative for that particular sector.
Okay, so viewers, excuse me for that. It's actually capture ratio, a term which, as Kaustubh said, does both of these. And Kaustubh, if I'm not wrong, your observations seem to suggest that Nippon India Pharma and SBI Healthcare Opportunities, the regular fund, growth options in both, are the ones with the better capture ratios of the lot.
That's right.
Okay, so viewers, for those of you who believe in the argument that Kaustubh was trying to make, maybe thematic investing is not for you. However, if you still believe that you would want to take the plunge, then look at this aspect, which is capture ratios, and try and look at that. And on the basis of that, if you heard the argument, then the two names, which is Nippon India Pharma and SBI Healthcare Opportunities, both the growth options, are the ones with the best of the lot, so to say, on a relative basis. So something to ponder over. Now, Rushabh, I want to come to you, because you are the one who believes that if one can time it, then it's actually a really good option to do, right? So let's assume you are constructive on healthcare funds currently. How do you choose them? What are the aspects you keep in mind? What is it that you recommend?
See, it's very simple, Neeraj. I mean, currently the valuations are trading below their 10-year average, long-term average. So this itself clearly says that, this is a really good time to venture into the healthcare segment. But as Kaustubh clearly said, that see, if someone is really not into this thematic and sectorial category, someone is not savvy, then probably might as well they take exposure through flexi cap or a focus funds, because fund managers eventually will take opportunity in different sectors and different stocks as per the markets fall or as per the companies fall accordingly. So again, this is mainly for savvy investors. And I would go for a fund which is thematic. There are many sectorial funds out there. So what a sector fund's done, it sticks to a particular sector. It has to stick to a particular sector. But when you say healthcare, there are so many factors which it's a theme. So I would rather bet on a theme fund where the fund manager has the liberty or the flexibility to choose more number of stocks. The universe is a little larger, for the fund manager to play with. So ICICI Prudential Pharma Healthcare and Diagnostics Fund is one of the funds which I really like. It falls into the thematic category, and most of the other funds they fall into the sectorial category. So just because the fund manager has a larger university to larger universe to choose his or her stocks, I would bet on a thematic fund rather than a sectorial fund.
Okay, interesting. Just last question out there, Rushabh, and that is, when I looked at what the stuff that you were recommending with regards to the healthcare segment, the names like the ICICI Pru Pharma and Healthcare and Diagnostics funds, for example, would give the fund manager, you are saying, or any other would give the fund manager the ability to pick across a diverse range of stocks and therefore lessen the downside risk because of the number of options available.
No, I wouldn't say lessen the downside risk. That is not the correct term I would look at it. See, when you invest in such a volatile and a cyclical product, it's not the downside you look at. It's more the upside what you look at when you
Fair
invest.
call.
During the bear market or during the tough times. So it's just it just gives more probability for the fund manager to deliver little higher returns. Even if you see the healthcare or the pharma category, many of the funds are outperforming the Nifty Healthcare TRI index, right? So in that way, if someone is looking, just to outbeat, that's fine. But in my view, if you choose a thematic fund, probably the thematic fund would be a little less volatile. I wouldn't say less cyclical, but little less volatile. And the upside of the thematic fund would be a little more higher than a pure sectorial fund. That's how I would like to put it.
Great. Well, both of you, thanks for giving your intelligence on two very important topics, both very topical, and therefore great to have both of you giving your insights and your funds. And your standard disclaimer, please choose these funds carefully before you go out and decide that these are apt for you. Do study them. If you do not have a financial advisor, if you have a financial advisor, please consult her or him. Kaustubh, Rushabh, thank you so much for taking the time out on the show today.
Thank you.
Thank you, Neeraj.
And viewers, thanks for tuning into this leg of the Mutual Fund Show.